Hello everyone! In 2023, the International Sustainability Standards Board, or ISSB, issued IFRS 1 General Requirements for Disclosure of Sustainability-Related Financial Information and IFRS 2 Climate-Related Disclosures, together the ISSB standards. Since then, especially in the past few months, several entities have published their first sustainability reports applying the ISSB standards. What are the practical lessons learned so far from the first year of ISSB reporting? This video highlights some of the matters entities may find helpful in planning and preparing for their sustainability reporting using ISSB standards. I'm Astrid Wessler, Senior Manager with EY's Global Corporate Reporting Services. And with me today is Victor Chan. Victor is an International Director with EY's Global Corporate Reporting Services. Victor, can you share some of the issues to be highlighted as more entities embark on their sustainability reporting journey?
Sure, Astrid. The first issue we would like to talk about is a reporting entity concept which defines the scoping of a sustainability report. An entity's sustainability-related disclosures are for the same reporting entity as its related financial statements. For example, an entity prepares consolidated financial statements in accordance with IFRS accounting standards and reports on sustainability in accordance with ISSB standards. The entity will use the parent and its consolidated subsidiaries as a single reporting entity for both financial and sustainability reporting purposes.
Does this mean that joint ventures and associates that are not subject to consolidation but accounted for by the parent using the equity method would not be part of the reporting entity?
That's right, but it is important to point out that joint ventures and associates are investees of the parent or its consolidated subsidiaries, and the investment relationship could give rise to sustainability-related risks and opportunities for the reporting entity. Often, joint ventures and associates are suppliers or customers of the reporting entity, and these relationships could also give rise to sustainability-related risks and opportunities similar to other parties along the value chain.
On the other hand, when entities disclose their greenhouse gas or GHG emissions, the scoping of the emissions could actually include associates and joint ventures. How does this affect the reporting entity?
Well, IFRS S2 requires an entity's disclosure of its greenhouse gas or GHG emissions to be calculated in accordance with Greenhouse Gas Protocol, a Corporate Accounting and Reporting Standard 2004, or GHG protocols, to the extent that those requirements don't conflict with IFRS S2. A reporting entity identifies its organizational boundary using either the equity share or control approach, and the control approach could be applied based on operational or financial control. Depending on the approach taken, a reporting entity may determine the organizational boundary to include joint ventures and associates, and thus the GHG emissions for an entity could also include those from joint ventures and associates. The approach taken will also affect the determination of GHG emissions of non-wholly owned subsidiaries as well as unconsolidated subsidiaries. But the organizational boundary doesn't affect the application of the reporting entity concept in other disclosure requirements under ISSB standards.
On screen, it shows extracts by the entity Vale in its sustainability report. The report includes both Vale, the parent company, and its subsidiaries, consistent with Vale's financial statements. For GHG emissions purposes, Vale uses the GHG protocol as required by IFRS S2. So it includes all Scope 1 and Scope 2 emissions from operations and assets over which it has operational control, and its proportional share of joint operations. Any other emissions generated in Vale's value chain are reported as Scope 3 emissions. The next item on our list is materiality. Victor, is it true that under the ISSB standards, the materiality concept is consistent with that for financial reporting under IFRS accounting standards?
That's right. We have included the definition from both the ISSB standards and IFRS accounting standards, and you can see on the screen the wording is consistent across both reporting frameworks. Entities apply the financial materiality concept in financial reporting, for example, when considering whether a transaction or event needs to be disclosed based on the quantitative effect of the transaction or event to the entity's financial performance. This example focuses on the quantitative characteristics of materiality.
In assessing whether information is material, an entity is required to consider both quantitative and qualitative factors. IFRS S1 requires an entity to assess what information is material and hence subject to disclose. Therefore, materiality is assessed at the information level and not just the numerical figure embodied in that information. IFRS S1 provides guidance explaining that an entity might consider the magnitude and the nature of the effect of the sustainability-related risk and opportunity on the entity.
And this is the same for financial reporting. However, given a large volume of disclosures in a sustainability report are qualitative in nature, an entity will likely need to pay more attention to the qualitative factors when identifying the material information to be disclosed. Take, for example, an entity that has manufacturing and sales operations in a foreign country, but if labor laws in that country are not strictly enforced, there could be, for example, child labor issues with the entity's local suppliers. Even if that foreign operation may not contribute to a significant portion of revenue nor profit to the entity, it needs to carefully evaluate the material information to be disclosed, giving due consideration to the qualitative factors.
In its sustainability report, the European Bank for Reconstruction and Development includes a discussion on how it applies the materiality concept. It explains that in the context of sustainability-related financial disclosures, information is considered material when applying the definition as provided in the standard. Disclosures are also considered material if they are identified as decision useful based on qualitative factors. While it considers climate-related credit risks to be immaterial from the perspective of financial reporting, these risks are considered material in the context of the sustainability report. Let's move on to the next item on the list, which is current and anticipated financial effects. The slide shows the requirements under IFRS S1 for an entity to disclose information to enable users of general purpose financial reports to understand the current financial effects of those sustainability-related risks and opportunities for the reporting period. An entity is also required to disclose its anticipated financial effects over the short, medium, and long term, taking into consideration how those sustainability-related risks and opportunities have been factored into the entity's financial planning. The required disclosures include both quantitative and qualitative information. IFRS S2 also includes the same requirements for climate-related disclosures.
So there is a boundary drawn in the standard between current and anticipated financial effects, depending on whether the entity's financial position, financial performance, and cash flows are affected during the current reporting period. Therefore, the current financial effects refer to those reported in the financial statements for the current period, and the anticipated financial effects are those effects that are expected to be reported in the financial statements in the future. An entity is not required to provide quantitative information about the current or anticipated financial effects of a sustainability-related risk or opportunity if the entity determines that either the effects are not separately identifiable or the level of measurement uncertainty involved in estimating those effects is so high that the resulting quantitative information would not be useful. However, distinguishing the current from anticipated financial effects is important because there are reliefs available for the disclosure of anticipated financial effects, but not for current financial effects. For the disclosure of anticipated financial effects, An entity firstly uses all reasonable and supportable information that is available at the reporting date without undue cost or effort. Secondly, an entity uses an approach that is commensurate with its skills, capabilities, and resources that are available to the entity for preparing those disclosures. In these situations, the entity is required to explain why it hasn't provided quantitative information and will need to consider additional qualitative disclosure requirements. This means that an entity needs to disclose the required information. However, it may choose, for example, to disclose qualitative rather than quantitative information.
Thank you very much, Victor. I think it's helpful to add that the ISSB has released educational material on this topic. Let's move to the next slide, which shows another example. Lochas Renner has included in its sustainability report the quantitative current financial effects by the different climate-related risks and opportunities. On the right-hand side, it has disclosed the anticipated financial effects by providing a range of figures for those identified risks and opportunities. It has also disclosed the anticipated financial effects arising from its transition plan. Just one more reminder before we move on to the next topic. An entity will need to provide information to users to enable them to understand the connections between the sustainability report and other documents included in the annual report, such as the financial statements, for example. When it comes to current financial effects, an entity may often be able to connect the sustainability information to information disclosed in the financial statements. Let's focus on climate resilience and scenario analysis.
IFRS S1 includes disclosure requirements about resilience. There are more specific disclosure requirements with respect to climate-related risks and opportunities under IFRS S2. An entity is required to, under IFRS S2, to provide information to enable users to understand the resilience of the entity's strategy and business model to climate-related changes, developments, and uncertainties, taking into consideration the entity's identified climate-related risks and opportunities. It would be helpful to highlight three disclosure requirements included in IFRS S2. Firstly, an entity discloses the implications, if any, of the entity's assessment of its strategy and business model. This would include how the entity would need to respond to the effects identified in the climate-related scenario analysis. Secondly, it discloses the significant areas of uncertainty considered in the entity's assessment of its climate resilience. Thirdly, the entity discloses its capacity to adjust or adapt its strategy and business model to climate change over the short, medium, and long term.
What are some of the lessons learned around scenario analysis?
There are also disclosure requirements about climate-related scenario analysis. An entity is required to disclose how the climate-related scenario analysis was carried out, the key assumptions the entity made in the analysis, as well as the reporting period in which the climate-related scenario analysis was carried out. Specifically, the disclosure needs to include an explanation about why the entity decided that it has chosen climate-related scenario analysis relevant to assessing its resilience to climate-related changes, developments, or uncertainties, as well as the scope of operations that an entity used in the analysis. Examples include the operating allocations and business units used in the analysis. Entities are reminded to consider whether the disclosures related to climate resilience and scenario analysis are robust enough based on these requirements.
Are all entities required to undertake scenario analysis?
Well, an entity is required to use climate-related scenario analysis to assess climate resilience. But there is a relief that allows an entity to use an approach that's commensurate with its circumstances. Therefore, a quantitative analysis may not be needed in every case, but other material information is still required.
Thanks so much, Victor. The next issue on the list is uncertainties and judgment.
There is a disclosure requirement in IFRS S1 that an entity discloses information that enables users to understand the judgments the entity has made in the process of preparing its sustainability report and that have the most significant effect on the information disclosed. Two typical examples are the identification of a sustainability-related risk or opportunity, as well as the identification of material information given the sustainability-related risk or opportunity.
When it comes to measurement uncertainty, the relevant guidance has been included on the slide. An entity is required to disclose information to enable users to understand the most significant uncertainties affecting the amounts in a sustainability report. An entity needs to identify the amounts that are subject to a high level of measurement uncertainty. For each of the amounts identified, the entity is required to disclose information about the sources of measurement uncertainty and the assumptions, approximations, and judgments it has made in measuring the amount.
What these requirements mean is that it is not sufficient to just acknowledge that there are judgments applied and that some amounts are subject to measurement uncertainty. Instead, an entity is required to provide sufficient detail about each judgment and the amount subject to measurement uncertainty so as to inform users. Last but not least, we would like to point out the importance of the structure of the sustainability report and the presentation of the content. A logical structure of the sustainability report will help users better understand the overarching messages as well as the specific disclosures. For example, when an entity identifies and discloses a sustainability-related risk or opportunity, users will want to understand the corresponding metrics the entity uses to monitor each of these risks and opportunities, the targets it has set, and the progress of each of the targets.
And this point is also related to the connectivity within the sustainability report as part of the requirements in IFRS S1. Specifically, an entity is required to provide information about the connections between various types of information, about a particular sustainability risk and opportunity, and the connections between disclosures of various sustainability risks and opportunities. One example is that when an entity provides information about connections between a sustainability risk, its strategy it has adopted, the anticipated financial effects, and the related metrics and targets, users will be able to understand how effective its strategy has been in addressing that specific sustainability risk.
That's right. Another point to mention is that some entities, in addition to the required disclosure requirements under ISSB standards, would want to provide disclosures that are not considered material. IFRS S1 is clear that such immaterial disclosures can be included in the report. However, the entity needs to ensure that these disclosures don't obscure or mislead the required disclosures. Therefore, entities preparing sustainability reports under ISSB standards may want to consider how to include and present immaterial information in the report, potentially using a different font and style from the material information, and how to ensure that it is not more prominent than the required disclosures. Some of the immaterial information may be included elsewhere in the annual report outside the sustainability report.
Thank you very much for your thoughts on those issues, Victor. I have one more question. What resources are available that can help preparers with their sustainability reporting?
For the past few years, EY has developed various materials on sustainability reporting using ISSB standards, and these are available on ey.com/IFRS. For example, one can access the climate and GHG disclosure checklists, the Good Climate Illustrative Sustainability Report, thought leadership series such as Applying IFRS publications, and IFRS Sustainability Development publications on ISSB standards, as well as other articles and videos. In addition, the 2025 edition of our flagship publication, International GAAP, which provides detailed guidance on financial and sustainability reporting, is also available. All these can be accessed online for free, and you can use the QR code on the screen, which will direct you to the corresponding website. This suite of materials will continue to expand over time to cover evolving developments on sustainability reporting under ISSB standards, and existing materials are also regularly updated. So do come back and visit ey.com/IFRS often.
And not to forget, the ISSB has also provided various supporting materials which are very helpful for entities reporting under ISSB standards. You can access them at ifrs.org. For example, there are educational materials on disclosing information about anticipated financial effects or disclosing information about an entity's climate-related transition, including information about transition plans. You can also access webcasts and webinars. Thank you for watching this video today. I hope these practical lessons learned will help you with your sustainability reporting journey.